Financial markets are hitting a breaking point right now, and the clearest indicator isn't a stock chart, but the fact that tech giants like Alphabet and Meta are projecting hundreds of billions in AI capital expenditures while investors actively punish them for it. That psychological shift is exactly what we need to unpack. For the last couple of years, the playbook on Wall Street was simple. You threw infinite money at artificial intelligence infrastructure, you watched the semiconductor stocks go parabolic, and you essentially printed money. But we have hit a wall. The euphoria has been replaced by a very cold, hard demand for return on investment, which makes this the most confusing, high-stakes market environment we have seen in years. We have Wall Street pulling in completely opposite directions. The AI trade just hit a massive air pocket. Bitcoin is caught in a tight tug-of-war in the mid-$60,000 range, and the macroeconomic headwinds are threatening to snap the whole thing. Daniel, before we get into the Federal Reserve and crypto, we have to start with the elephant in the room, big tech and this AI reality check.
The numbers coming out of the tech sector are staggering. We are looking at a Goldman Sachs report estimating a $757 billion AI capital expenditure supercycle over the next few years. That is an oceanic amount of capital being deployed into data centers, power cooling systems, and networking upgrades. Alphabet just revised its full-year 2026 capital expenditure forecast up to roughly $200 billion. Meta paired a slightly weaker sales forecast with commitments for almost $700 billion in future spending.
And the market's reaction was brutal. Meta shares dropped significantly. Alphabet took a 7% hit right after that projection. The semiconductor complex, which is the immediate beneficiary of all this spending, took a heavy hit that dragged the Nasdaq down with it. Why are investors suddenly terrified of the exact thing they were cheering for 12 months ago?
Because capital expenditure is essentially a debt against future earnings. When a company builds a massive data center, that cost hits their balance sheet immediately, but the revenue generated by the AI applications running in that data center might not materialize for years. In 2024 and 2025, the market was trading on the pure potential of generative AI. It was a gold rush, and everyone was buying the pick and shovel makers like NVIDIA and AMD. But now, analysts are looking at these hundreds of billions of dollars and asking a very basic business question. Who is paying for the actual AI software to justify this hardware cost?
It feels like a transition from blind faith to traditional valuation metrics. The market is finally asking for the receipts. If you are spending $200 billion, you need to show how that translates to profit margins, not just technological capability.
Precisely. And that introduces severe vulnerability. Many of these companies have borrowed heavily to fund this expansion. If the return on investment timeline stretches out longer than anticipated, those high costs will compress profit margins. The tech sector has been the primary engine of the recent market rally, so when it sneezes, the broader market catches a cold. Investors are recalibrating the pace and the financing of this AI infrastructure build-out.
Which leads us to the other asset class that typically trades on forward-looking liquidity and tech sentiment, and that is crypto. Bitcoin has been on a wild ride recently, but it seems completely stuck. It spent most of July and early August range-bound between the high 50s and mid-$60,000 marks. It is a classic squeeze.
The dynamic in Bitcoin right now is a fascinating case study in market mechanics. On one side, you have an immense structural floor being built by institutional capital. U.S. spot Bitcoin ETFs have pulled in roughly $58 billion of cumulative net inflows since they launched in early 2024. Just recently, we saw another $626 million flow into these funds over a 3-day period. BlackRock's iShares Bitcoin Trust alone is holding over $54 billion in assets under management.
So the institutional appetite is clearly there. They are absorbing the supply that comes onto the market, but the price is still capped. We aren't seeing the explosive breakout that the bulls are anticipating. What is providing the ceiling?
The ceiling is a combination of technical exhaustion and regulatory stagnation. While the ETFs are vacuuming up supply, retail investors are largely sitting on the sidelines. We are not seeing the viral retail mania that characterized the 2021 bull market. Furthermore, there is a lack of clarity on the regulatory front. Banking executives are openly stating that they are waiting for a single federal regulatory framework before they fully commit institutional liquidity into the space. That friction slows down the velocity of capital.
It is a tug-of-war. The long-term holders and the ETF inflows are refusing to budge, keeping the hard money narrative alive. But the technical momentum has cooled. The tension is palpable, and it feels like a break of key support could trigger a deeper flush, while a catalyst could send it rocketing. But we can't look at tech or Bitcoin in a vacuum. Everything eventually rolls up to the macroeconomic environment.
That is the ultimate gravity for all these markets. The macroeconomic picture right now is walking a very dangerous tightrope, largely because the Federal Reserve is facing a nearly impossible dual mandate dilemma.
Let's break that down, because the Fed held interest rates steady at 3.5 to 3.75% in July, which was expected. But the internal divisions and the data coming out are painting a very chaotic picture. Fed Chair Kevin Warsh is taking a lot of heat right now.
He is in a remarkably tough position. The Fed is dealing with conflicting signals. On one hand, inflation is proving to be incredibly sticky. The July Consumer Price Index data and upcoming personal consumption expenditures reports are showing signs of slight reacceleration, driven largely by energy prices and core services. You have analysts at JP Morgan predicting that the Fed might actually have to hike rates by 25 basis points in December because price pressures refuse to go away.
A rate hike in this environment would send shockwaves through the system, especially when you look at the other side of the Fed's mandate, which is employment. The labor market is flashing serious warning signs.
Exactly. The July jobs report was dismal. Employers unexpectedly shed 23,000 jobs, and the data for May and June were revised downward by over 100,000. So you have a stalling labor market that desperately needs lower interest rates to spur business investment and hiring. But if the Fed cuts rates to save the jobs market, they risk pouring gasoline on the inflation fire that is already reaccelerating.
It is a classic stagflationary threat. Prices are rising, but economic growth and employment are stalling. That explains why the Federal Open Market Committee is so fractured. You have a loud faction of dissenters pushing for rate hikes to kill inflation once and for all, and others terrified of a severe recession if they don't ease up.
And this macro uncertainty bleeds directly back into our previous points. Think about those tech companies borrowing billions to build AI data centers. If the Fed is forced to hike rates or even just hold them higher for longer, the cost of servicing that debt increases. That puts even more pressure on their profit margins, which further spooks the stock market.
And for Bitcoin, higher interest rates strengthen the US dollar and increase the yield on risk-free assets like treasury bonds. If an investor can get a guaranteed 4% return on a government bond, they are less likely to park their capital in a volatile, non-yielding asset like Bitcoin, regardless of the ETF inflows.
That interconnectedness is what makes the current moment a breaking point. We have three massive narratives: the AI infrastructure build-out, the institutionalization of crypto, and the fight against sticky inflation, all colliding simultaneously. For the past decade, passive buying strategy worked because liquidity was abundant and interest rates were at zero. You could throw a dart at a board of tech stocks and make a profit.
But that era is definitively over. Volatility is back and complacency is dangerous. We are looking at a market that requires active analysis and a deep understanding of these underlying currents. You have to evaluate the actual ROI of AI spending, monitor the ETF accumulation in Bitcoin against technical support levels, and anticipate a Federal Reserve that might be forced to make a deeply unpopular decision.
The margin for error is razor thin. Whether you are buying the tech dip, hoarding cash, or rotating into defensive assets, the strategy requires recognizing that the structural foundations of the market have fundamentally shifted.
It is a complex puzzle, but mapping out these tensions is the only way to navigate what comes next. If this breakdown helped clarify the chaos for you, send this episode to a friend who is trying to make sense of the markets right now.